Okay, so again, what we're doing is I'm creating the economic profit tab, which is the one thing that we didn't really talk about last week. We kind of ran out of time. And the idea of economic profit, and to some degree ROIC, is we can put these on the same tab rather than having two tabs, which is in the posted solution. So in this case, to calculate economic profit, I need an ROIC. So I go off my TII and I get my NOPLAT. And then I need invested capital, which I'll get off of my TFI. All right, now what I'm calculating is, and I'm asking for you, a beginning of year ROIC, right? So what I mean by that is that beginning of year ROIC, the formula is NOPLAT divided by invested capital. So for 2011, I take my 2011 NOPLAT and I basically divide it by my 2010 invested capital. That's what we mean by beginning of year invested capital. It's the return on the starting invested capital, which is basically the return on the ending last year's invested capital. So in that case, it would be the 4.6%. And if I copy and paste that over, 4.34%. Okay, so that would be the return on the invested capital. As opposed to the end of year ROIC, which would be the current year's NOPLAT divided by the current year invested capital. All right, so notice that those are different numbers. Matter of fact, what some people do is they'll do an average ROIC. So what they'll do is they'll take equals the current year NOPLAT divided by last year invested capital plus this year invested capital divided by 2. So I could do return on sort of average invested capital. I could do return on beginning invested capital. I could do return on ending invested capital. Notice they give me 3 different answers. Right? For purposes of your assignment and your midterm, I'm going to ask you to do return on beginning of year invested capital. And the primary reason, and you'll see this a little bit later tonight, is that when we build out the valuation model, we get an exact valuation match between the economic profit and the DCF valuations if we use beginning of year ROIC. If we use end of year or average, we're close. Okay? So for purposes of this class, I want you to get an exact match between the 2 valuation methods. Therefore, I'm going to ask that we use beginning of year ROIC. Right? But in the real world, it'll sort of be an it depends. Okay? So why do you think we might want to use a beginning of year ROIC for a company? What do you think? Yeah. Yeah, so let's say that a company is making a big investment in stuff that hasn't been built yet. When I look at the ROIC, I'm trying to understand what its model is on a go-forward basis. I don't want to include the work in process in the ROIC calculation because it doesn't really tell me how well they're doing, because what I really want to look at is the return on the assets that are actually being employed. So that's often why people will use a beginning of year ROIC, because they'll say, look, here's a company that makes big investments. It could take a while before the stuff shows up. So I don't want to penalize them by basically saying they get a lower return, even though realistically their actual return on the investment once it's employed will be higher, but it'll be lower because I'm giving them invested capital where sales and revenue and profits haven't occurred yet. So beginning of year ROIC. End of year ROIC says, you know what, from an investor standpoint, I just want to look at the return on my investment. I want to look at how much capital I gave them, and I want to look at the profit that they earn on the total invested capital. Whether it's work in process or whether or not it's not being used, they tied up my capital, and they have to get a return on my capital. End of year ROIC. Then we have the compromise, average ROIC. Right? I want to look at the beginning plus end divided by 2. I want to look at kind of a smoothing between the two. Right? And I've seen companies use all 3. All right. And it's not saying one is better than another. Kind of deals with the nature of the business on a go-forward basis is what I want to understand. Because return on invested capital is a proxy for cash flow. So ultimately, I want a return on invested capital calculation that will be a good proxy for my ability to generate cash flow on a continued basis. That's what I'm really looking for when I'm deciding between the calculations. For purposes of this assignment, we're using beginning of year just because, as I said, I want to balance out the valuations. So I'm just going to do it on beginning of year. So no plat divided by last year's invested capital, beginning of year ROIC. Okay. Then we need to calculate economic profit, so we do it by spread, which means I need a WACC. Well, in our model, I gave you a WACC. In the homework assignment, it was 9%. I will vary this WACC on your midterm. Right? I will vary the tax rate on the midterm. Don't really destroy your entire grade for the semester because you don't pay attention to the assumptions that change as the exam changes. Okay? So that gets me a spread. The spread is the beginning of year invested capital minus the WACC. Okay? So what is economic profit? In order to calculate economic profit, I take my no plat and then I subtract what's called the capital charge. And that gets me economic profit or EVA. Well, no plat equals the current year's no plat. Capital charge equals the WACC or the cost of capital times the beginning of year invested capital. So I started with 3460. Investors are charging me 9% to employ that money for the year coming. So therefore, in order to give them a 9% return on the starting invested capital, I need to make 311.4. If I make 311.4, then I make exactly 9%. I made 161. I was 150.4 short. That's my negative economic value added, negative economic profit. All right. So I was basically 150 million short of making a 9% rate of return. I did not create value during this period of time. Okay. Same thing. In 2012 equals my no plat. Capital charge is the cost of capital times the beginning of year invested capital. I made 133. Given $3 billion of starting capital at 9%, I needed to make 275.58. I was that minus that, 142.58 short. Right? Nice thing about all these statements, there's two ways to calculate economic value added. One is I take no plat minus capital charge. Right? So again, capital charge is defined here. Second way is I take the spread method. I take my spread, which is that number. ROIC minus WACC equals spread. Okay, and again, based on beginning of year ROIC. And I multiply the spread times the invested capital. Equals beginning of year invested capital and that gets me economic profit equals that times that. Notice that these exactly balance. It's just rearranged equations. So two ways to get economic value added. One is the spread method. Did I meet my investors' expectations? I was negative 4.35% in the first year, negative 4.66% in the second year, short of meeting investor expectations. Cost of capital. Take my spread times the capital employed, start with my beginning of year invested capital, and that gets me my economic profit. Right? Or, as I said, option B is I can look at no plat minus capital charge. Capital charge equals my invested capital beginning of year times my WACC. That's how much I have to make to get a 9% rate of return. 9% of the invested capital from last year. That's what I made minus the capital charge equals the economic profit or the EVA. Yes?
So is the 150 how much higher the no plat had to be or the invested capital
had to be? This is how much higher the no plat would have to be. So if my no plat was, and again I'll save this so I can undo it. If my no plat was 311.4, then I would have a 0 spread and I would have a 0 economic value added. It basically means I earned exactly what I was expected for the capital and the risk that was employed. If my no plat was 375, then I earned $63 million more, $63.6 million more than was necessary to meet a 9% expectation. So in a way, it's kind of like an NPV. All right, it's just an NPV for one period. Okay, that's economic profit. It's just a one period change in value of the company. All right. As a matter of fact, the valuation of that is if I forecast all the changes in values, I get the value of the firm over time. Right. Questions about this? Hopefully pretty straightforward. Okay, so what I'll do is I will also save this. Let me undo what I just did so it matches the homework. And I will post this file to Canvas as well. Okay. So let's go back to this file and let's talk about what this means. So again, given our Modigliani-Miller framework, we have sort of 4 sections of TFI. The real advantage to doing the economic conversion is I have sort of my, here it is, in my invested capital. So this is how much cash is now, yes?
All right.
Okay.
In the book, I think, I don't know what to do, but I think that they used retained earnings on the CFI, but it wasn't all retained earnings. It was adjustment. Like, when would you use that?
Well, this gets into more of the advanced stuff we'll probably talk about after the midterm, but just as an example, let's say that a company has some deferred taxes. So that they have a balance sheet account with some deferred taxes. So what happens is they've actually written down their equity. So it looks like they have less equity, but they actually have the cash in the firm. So the idea is I don't want to distort my return in invested capital. So one thing that I would do is I would add back that amount to represent the actual invested capital that the company has in the firm. So I'll make adjustments where I took some non-cash charges to equity and I'll readjust my equity so it represents the actual cash that I'm retaining in the firm. So those are some of the advanced adjustments that the book will talk about. The firm that created this, Stern Stewart, they list a minimum of 300 adjustments they make to the financial statements to try and get to this. To be honest with you, I've started looking at some of their adjustments and you get so confused you don't even know what you have after you've actually made all those adjustments. It's like a Frankenstein statement. And in a way, what we really want is simplicity. We just want cash. We want to know how much cash I have tied up in the business. We want to know how much cash profit I get, and we want to know what that cash flow generation looks over time. That's really what we're trying to ultimately adjust to. And so that's the idea here. I have my invested capital, which is the cash tied up in my operations. That's what I'm really trying to represent. Then I'm trying to represent the cash tied up in the non-operating activities, and then I'm trying to represent the cash from financing, all right, debt and equity financing that finance the business. Matter of fact, I did the same thing with my TII. Here's my no plat. Here's the profit from operating activities. Here's the profit from non-operating activities. Here's my financing flows to the business. Okay. Now, again, why might I do this? Well, I'm going to go back to this. I'm going to add something that wasn't on the solution. But I'm going to add in my, we'll just call this non-operating capital. And my non-operating capital are really those things. Actually, equals the assets minus any liabilities. That's my non-operating capital. Those two minus that. And by the way, if I add my invested capital plus my non-operating capital, I get my TFI. Just kind of illustrating what the TFI was. Right? Now you might say, gee, why would McKinsey break it out this way? Well, think about one of the things we focus on, return on invested capital. Well, return on invested capital, if I really think about it, is take my ROIC here. Return on invested capital is my, and I'll do this for 2012 as an example here, equals my NOPLAT off of my TII for 2012 divided by, from the TFI, my invested capital for, and I'm going to confuse you completely, but just to keep it simple, I'm going to divide it by my 2012 invested capital. So if I did a end of year ROIC, it would be 3.7%. Okay. Now, this is what we'll call operating ROIC. So let me talk to you about Bloomberg ROIC. All right, so let's put that right here. Bloomberg ROIC for 2012 is going to take the NOPLAT. So they'll calculate NOPLAT very similar, but the difference is they'll divide it by the debt and the equity, which means they're doing a return on TFI. So if you look up ROIC in Bloomberg or Thomson Reuters or CapIQ or any other professional data service, when they do return on invested capital, they're actually doing a return on what we call TFI, return on total funds available to investors, because they're basing it on the debt and equity of the firm. All right? And what we're doing is more of an operating ROIC. But here's the thing. What's the difference between the operating ROIC and the TFI? It's the non-operating performance. So what I could actually do is I could do a non-operating ROIC for 2012 equals my, when I go to my TII, I look at my non-operating income. So I could actually have a line for this. So what I could do is I could take my so my total non-operating, which equals that plus that, which is the 28. So the idea here, I go back to this screen, equals from the TII, the total non-operating income, the 31.5 minus the 3.5, divide that by my non-operating investments, non-operating capital. Again, that's based on end of year. So here's what we're saying, is that I can look at a return on my operating. Does that look right? It doesn't look right about that, because this number shouldn't be, if this number's here, the number's there. Am I doing that right? TFI. Non-operating income. Interest income. I'm sorry?
Is that because it's TII?
Yeah, I want to do TII. I want to do the interest. Oh, I'm doing interest income. Sorry, I was in the wrong. I want my non-operating gains and losses. I threw an interest income there by mistake. My mistake. It's just this non-operating gain and loss. So negative 3.5. Go back to the street. Here. Start this again. Equals TII, my non-operating income or loss after tax, divided by my non-operating capital here. There we go. Negative 0.6%. So that's the point. My overall return on the business in Bloomberg is 3.3. But my return on my operations is 3.7, and my return on non-operating is negative 0.6. Now, the business is the average of these two, which is how we average out to 3.3. But by splitting it out, I can see what the operating value of my business is. I have a model for my operations, and I have a model for my non-operating activities. That's what I was trying to get to. Yes?
How come you don't include the investment income as in the non-operating ROIs?
In TII, that's what the non-operating income is.
So you don't include interest income.
Interest income goes to, sorry, you're right, that is a 2. I do have to include it. You're right, so I would actually put the interest income in there. All right, so scratch what I was trying to do here. I'm getting myself confused. But that was really the point. I don't want to confuse you too much on the actual spreadsheet more than I already done this. But the idea is I have a different return on my operating performance, a different return on my non-operating performance, as opposed to an overall return on my total funds invested. So by breaking it out this way, that's one of the things that we do. Now, for analysis, what really matters is what happens on the CFI. The CFI is where we're doing most of our analysis. Right? Yes?
Almost that exact same thing screwed me up for a while on Sunday when I was trying to do this, because I kept including interest income into after-tax non-operating income on my CFI. Is it excluded because it's not cash?
No, it has to be in there.
It has to be.
Yeah, so if I look at my CFI, you're talking about my CFI? So I have my interest income is a 2, so I do have to include it. And then I have to have my non-operating income off the income statement. And then I have to have my change in excess cash, change in equity investments, and change in other long-term operating liabilities. So I would have to actually include it. Yeah, that's the only way my statement's going to balance. All right. But here's the thing. Here's the story. Free cash flow. Free cash flow tells us whether or not our operations are generating cash, therefore have any value. If we don't have free cash flow, we don't have value. Because remember, free cash flow is the cash that can be paid out to our investors. So in this case, in 2011, we generated $559 million worth of free cash flow. In 2012, we were at negative $355. So basically, in 2011, we had cash to pay out. In 2012, we had a shortfall from operating activities. All right, so if I just look at our operations, our operating activities chewed up $355 million worth of cash in 2012, but they generated $559 million of cash to pay out in 2011. Okay? Now, cash flow available to investors. When I take into account my non-operating activities, in this case, I took the $559 million and I tied up a little over $300 million in my business. Where did I primarily tie it up? In this case, I tied it up by putting $250 million, buying a stake of another business, and I put a little bit in my savings account. Okay? But I still had cash flow available to pay out to my investors. So the question is, where did the money go? Well, in this case, $43 million went to pay interest, $245 million went to pay treasury stock. Now notice that 245 plus 43 is already greater than 213. Okay? I paid 25 to minority shareholders. I paid 60 in dividends. So therefore, I had to borrow 160 of new debt to afford to pay off the equity that I paid off. Right? So I really couldn't afford to pay off and buy back the treasury stock of 245 because I only had 213. Right? And when I paid dividends and interest, that's why this company had to lever up. That's why this company had to borrow money. And I can clearly see this. So here's a question that I asked on the midterm exam that's likely to show up on your midterm exam next week. In 2011, does this company, given this data in front of you, need to borrow money? Well, we got the yeses and the nos covered.
You didn't have to pay out all this other
So let me rephrase the question. Why did this company borrow money?
gave all the money to investors.
It gave all the money to the investors. So I'm going to ask the question in a slightly different way. Did this company in 2011 need to borrow money to fund its operations? No. So what we can clearly see is that this was discretionary. Right? This was a recapitalization of their balance sheet. They decided they wanted to have some debt, and they wanted to take the debt to pay off the equity. They didn't really use the debt to fund their operations. How do I know that? By looking at this data.
Positive cash flow.
Because they have positive which cash flow? Positive free cash flow. Because free cash flow says from their operations are generating more cash than they're reinvesting. So they didn't need the debt to fund their operations. Yes?
To what extent do we evaluate capital expenditures and whether or not those were discretionary? So like they
Well, every expenditure is ultimately discretionary. So I guess discretionary is maybe not the best choice of word here, but the idea is that this company generated more cash than it spent, so they didn't really need the debt. This debt wasn't necessary to fund its investment. This debt was basically necessary to buy back its stock. Right? And I'm just telling you that when you put the statement in this format, it becomes more clear about why they're actually borrowing or spending money. Look at 2012. What's the difference in 2012? Well, start out with free cash flow is now negative. Why is the free cash flow so negative? What are they doing? Huge capital expenditure, and there's an and here. They made an acquisition. So they spent $660 million in CapEx, and they spent about $150 million of goodwill and intangibles on an acquisition. So now they made a huge $748 million net investment, all right, which doubled almost what their cash profit from their income statement was. So they had huge negative free cash flow. Now, interestingly, they had negative 227 of CFI. So they were short, but they weren't 355 short. They were only 227 short when you included non-operating activities. Why didn't they need to borrow 355? What did they do? Well, in this case, they sold off some equity investments, and they got some extra non-operating liabilities. So basically, they didn't pay some bills, and they sold off some equity investments. Now, that also raised their excess cash. That raised their cash balance. So if we were looking at their balance sheet, we would see more cash flow on their balance sheet. But that doesn't mean that the firm is better off. As a matter of fact, we have a couple warning signs. One, operations, they chewed up a lot of cash. And for non-operating activities, the way that they kind of disguise this on their balance sheet, and the fact is that they actually had, I can go back to my balance sheet, they ended the year with more cash than they started, which you could say, gee, that means they must be a healthier company. No. What they did is they sold off some stuff and they didn't pay some bills to get more cash, right? But they still were negative 227. Where did this money come from? They issued some long-term debt, and they also issued some preferred shares, right? Now, is this necessary? Unlike this, when I said that was discretionary for what? Why did they have to issue the long-term debt here? Because they had negative free cash flow because they spent a lot on CapEx and an acquisition. So I can clearly see that this debt issuance was funding that investment in the business. This debt issuance was funding financing to repay their investors. Does everybody see that? How we can draw those conclusions? Because that's what you're going to have to do with what's called the CFI analysis. Is you have to look at the four parts of CFI. And the four parts are operating, non-operating, debt, and equity. And you kind of want to see what's happening between those four statements because it tells you a lot about the firm and the strategy of the firm and what it's trying to accomplish. Right? Just to put this into perspective, this afternoon, right? Just on a whim, my undergrads are now finished with their valuation model and we're just doing case studies. So I said, what the heck, let's look at BlackBerry. Because BlackBerry last week couldn't sell themselves to anybody, right? They tried, right? They had actually 3 bidders. Anybody read the article that BlackBerry had 3 bidders? Reuters wrote a report that said there were rumors that BlackBerry had 3 bids. One was from Lenovo, and the Canadian government nixed it because they said there's no way we're going to let the Chinese have Canadian IP. So basically, Lenovo was not allowed to buy BlackBerry. Second bidder and third bidder were Microsoft and Apple. They actually put a bid in for BlackBerry, except neither one of them bid for the whole company. They only bid for their patents. And basically, what happened was the board said no. We're not just going to sell our patents. You'd have to buy the whole company. They said, we don't want the whole company, so no deal was reached. Okay, so that was the rumors that came out last week about the BlackBerry bids. So I said, all right, let's try and value BlackBerry. And one thing that I quickly found is that BlackBerry is very complicated. And I really stressed out my undergrads. That's okay. They'll survive. But we use the valuation model we're going to build in class tonight. But one of the things, and this gets to CFI, this is the CFI for BlackBerry over the last few years, right? And so that's the point, is that when we do this analysis, it's the same for a real company. Now, what's interesting is on BlackBerry's actual balance sheet, their cash balance between 2012 and 2013, they just reported 2013 results, fiscal 2013 for them. Their cash balance went up, right, in the real world. These two are their total cash balances. It went from about $1.8 billion to about $2.6 billion. So if you look at their cash and their balance sheet, you'd say, you know what, sky's not falling, okay, because at least they have cash, all right? But that's a misnomer. So if we look at their CFI, we can see a little bit more difference in what's happening in their firm. So basically, their free cash flow in 2013 was positive. But the reason it was positive is because they slashed their investment, which had been averaging about 1.9 billion a year to $500 million. And the way that they slashed their investment is that their capital expenditures were still $1.5 billion. Not that different than what they'd spent in previous years, but they had a big decrease in working capital of $1 billion. So they basically generated a lot of free cash flow by taking money out of working capital. Okay, we can clearly see that on the CFI. When we did a little bit more digging, what we could also see is that the way they actually did this, and I'll show you this in days, inventory days went from 36 to 38, which means they have more inventory than when they started. Okay, that doesn't help working capital. DSO, which is collection from customers, went from 61 to 78. Well, that doesn't help working capital. Payable days to vendors went from 26 to 68. That helps working capital. So the way the BlackBerry company actually got a bunch of cash is they stopped paying their bills. And they went from a little under 1 month to a little over 2 months. And that generated, and you can see it on their absolute balance sheet, you can see right here under accounts payable went up dramatically from $740 million to $1 billion, and then some other stuff in the short term. But that was the point. They basically absolutely had less inventory. They went from $1 billion of inventory to $600 million of inventory. They went from receivables of $1 billion, $3 billion of receivables to $2.3 billion of receivables. So it made it look like they're collecting faster, they're getting rid of inventory, but they're just not paying their bills. And they're putting it into their cash to make it look like they have more cash. Probably to dress the business up. And I'm telling you that the sophisticated institutions saw right through this. And that's part of the reason why BlackBerry couldn't get any financing, because they realized that it was a smoke and mirrors game that they were actually playing with their financials when you started to see what they did. Because what they were trying to do is make it look like they were generating all this free cash flow. But all this free cash flow came from the fact that they didn't pay their bills. All right? So even though the free cash flow looked attractive for BlackBerry, it really wasn't. By the way, if we look over a 5-year period, BlackBerry was doing pretty well with their free cash flow. They generated about $6.5 billion. They also had about $2.7 billion of CFI. All of that, by the way, was in 2011. The last 2 years, almost no CFI. Interestingly, if you look at BlackBerry, they bought back over a 5-year period of time $3 billion worth of stock. They have no debt. All of the stock buyback occurred in 2010, 2011. They virtually bought back no stock in the last 2 years. Again, why do you think this is the case? Why do you think BlackBerry slowed their share repurchase? Because if they're not performing well, now might be a good time to start buying back the stock because the stock price is falling. Their stock price is down 93% from its peak. Why do you think they're not buying back their stock? Because they can't borrow. And they're just basically like chestnuts going for a really rough winter. They're hoarding cash. And here's the other thing from Bloomberg. This is the earnings estimates from Bloomberg for BlackBerry for the next 2 years. Their revenue, I actually put them in here, it's easier to see on this. Their revenue peaked, it went from 11 billion to 15 billion to 20 billion to 18 billion. Last year, 11 billion. That's what they just reported. The consensus estimate, 8 billion and 5 billion in the next 2 years. That in 2015, the current estimate is they will have 25% of the sales they had in 2011. And their operating profits turn into huge losses. The current consensus is next year they're going to have a $1.6 billion operating loss, and they're going to have negative EBITDA of negative 220 million. So that's the point. That's the current consensus that Wall Street has on BlackBerry. So this is all about hoarding cash. And I'm just telling you, when the banks are looking at the stuff in the format that we're looking at it, if you can't generate free cash flow, you can't pay me back. And unfortunately, with their sales and profits collapsing, and the fact that they really don't have the cash to pay out because their market share is dwindling, then basically that's why nobody wanted to buy them. Okay, so this is where we're getting to. Maybe we'll do BlackBerry ourselves in a couple weeks because, again, it's a little bit more difficult to value. But as I said, when you put it in this format, it actually starts to show you what's going on with BlackBerry. Matter of fact, one of the things we're going to do tonight was we're going to look at the operating value, and the operating value of BlackBerry is negative, which basically says in the model that we're building on a cash basis, their handset business is worthless. Right? So as a matter of fact, think about the board's perspective. They have about $2.5 billion worth of cash, excess cash. They have 500 million shares outstanding. $5 of their stock price is cash on hand. And today they're at $6.50 a share. That was their current share price earlier today. So if we actually value them at $6.50 a share, 5 of the $6.50 in cash is just, or of their stock price is cash on hand. So that's the point, is that if you throw in their IP is probably worth, given the current share price, about $750 million. And the handset business is worthless. That's why Apple and Microsoft and all these other vendors looked at them, Google included, and said, you know what, we just want the IP. We don't want your handset business. And that's why the board said we're not going to sell the company. Why'd the board say we're not going to sell the company, given the data I just gave you? What do you think the board's thinking? If they just sell the IP and they keep a worthless handset business, then there is no more BlackBerry. It basically kills the company. It's like suicide. So that's why the board turned it down, because they basically said the only value here is the IP. And if we get rid of the IP, then all we're left with is cash and a money-losing business. So at what point are the investors going to let us put cash into a money-losing business with no value whatsoever? So that's why they couldn't sell. Right? So stock price is going to be in this range. By the way, in about 3 months, they're going to sell at this range because they're going to realize it's hopeless. They're going to throw in the towel. But that's a conversation for about 2 weeks from now. Right? Back to where we are today. Then, ROIC. Let's go back to this company. This company has an ROIC in the low to mid fours. So what does that make you feel about this negative free cash flow and this big capital expenditures? How do you feel about that? You feel good? Feel not so good?
Not so good. They're making bad investments.
Now again, we don't know what the future's like, but that's the point. When does it make sense to invest? When what happens?
You have positive spread.
We have positive spread. That's when growth is valuable. So that's the idea, is that negative free cash flow is not necessarily bad if I have an expectation for positive free cash flow and positive spread in the future. The challenge with this company is when I have a negative cash flow and a consistent negative spread, and I don't see dramatic turnaround in the future, then I start getting concerned because I'm like, you're just throwing money away. So that's why we have to look at the spread, because the spread is just an indicator of the growth spread key value drivers. And so I can have negative cash flow so long as I have a positive spread in the future, because then my free cash flow will pay off even bigger. All right. If I have a negative spread expectation in the future, what do you think I'd rather have right now? Probably I'd rather have positive free cash flow, because then I'd like to be paying back the cash to investors and I'm not wasting it on bad projects in the future. Okay, so in that case, that's what I want to have in 2011. 2011, I want to have free cash flow, and I want to be buying back my stock, because by buying back my stock, it prevents me from making bad capital investments, because I don't have the capital to reinvest because I paid it out. Okay, so that's where I am now the mature stock. All right, now I am not the growth stock. Now I am mature dividend-paying stock. Right, as opposed to the growth company, which is growth, negative cash flow, but expecting high rates of return. So by having these two statements, it allows us to do this type of analysis. And again, more importantly, is the forward-looking view of this analysis, because we care more about the forward numbers, but nonetheless, we get a sense of the past, can infer what could happen in the future, especially for big companies that are more mature. Questions, comments? Make sense? All right. So, again, this has been posted. I will close out of this, and go back to our lecture notes tonight. So where we left off in our lecture notes last week, (2013), is we talked about the enterprise DCF, and we talked about the economic profit models, and we talked about APV for a few minutes as well. And then we talked about converting the statements to cash flow, right? That's where we were, right? So here's what we're going to do tonight. Tonight, we're going to focus on, open up lecture 3, valuing a company from a cash flow basis, right? So there are 5 steps that we're going to do in the cash flow valuation. We're going to accomplish most of those steps tonight. 4 of the 5 steps we're going to accomplish tonight. So, first, in order to predict the future, we have to analyze the past. In order to analyze the past, we have to convert the accounting statements into an economic format, right? So we're going to start with that. Second, we're going to start forecasting financial statements, right? And as the reading for this week talked about, we have to forecast cash flows forever, right? The challenge, though, is it's really hard to forecast cash flows forever. So when I was working with Google earlier this summer, I asked them a question, sitting in a room like this. I said, so Google, what's your revenue going to be in the year 2050? And everybody had a good laugh at that. Because they don't know. Nobody knows. But yet, if we value a company, we have to predict that. So what we do is we value a company by predicting a certain amount of years, and then we stop predicting and we proxy the long run. Okay? So what that creates is two periods of forecasting. One called the explicit forecast period or the defined forecast period, and then we go into what's called the continuing value period. So typically I'll forecast 5, 10, 15 years, and then I'll realize that forecasting after that is a meaningless exercise. So I'll proxy the long term using continuing value. Okay, so that's what I'm going to do in my valuation. Right, so I'm going to value the company for an explicit amount of years, and then have a defined period, and then go into continuing value. So again, one of the questions I asked on last year's final exam was, how long do I forecast before I go into continuing value? In an ideal world, I want to forecast enough years so that when I go into continuing value, the company I'm valuing is mature. Right? Because when I go into continuing value, I'm going to use the key value driver formula to proxy the continuing value of the firm, which means that 3 numbers in the growing perpetuity, which became 4 numbers in the key value driver formula, will represent 70 to 80% of a company's value. And if I want 70 to 80% of a company's value to be on 3 numbers, then I want those 3 numbers to be relatively predictable. So if I'm in an early growth stage and those numbers are much harder to predict, then I probably don't want to go into continuing value. So that's the idea, is that I want to forecast enough years for the company to be mature so that I can use the continuing value, the key value driver formula for my continuing value. So if I'm valuing a company like Google, I might need to forecast 15 or 20 years individually before I think Google is finally a mature company. If I'm valuing CSX, the railroad, I'm done. I mean, they're growing 2% a year. I might go 3 years, I might go 5 years just for the heck of it to look like I did some work. But basically, 5 years is probably enough for a CSX because they're growing 2% a year and they're just growing with GDP. So I don't really have to go that many years before I apply continuing value. Right? So that's where I have to decide what my length of forecast is based on my understanding of companies. By the way, what do I do with a LinkedIn? Because with a LinkedIn, they're not even making any money. How do I know how long it's going to take LinkedIn to be mature? We don't. So here's what we do. We use multiples. That's where multiple valuation comes in, is that multiples are linked to cash flow valuation. So when I have an early stage company and their cash flow is too hard to predict, then I use multiples instead of cash flows. When I have a mature company that's much easier to predict, then I use cash flows instead of multiples. All right. Ideally, I can use both on either one. And on a mature company, I'll do a multiple valuation and a cash flow valuation because I have the data. But early stage companies where it's too hard to figure out when they're going to be mature, much less how big they're going to be to mature, that's when I'll use multiples to value the company. So that's the major difference between multiple-based valuation and cash flow-based valuation, because they ultimately have to give you the same answer. All right. Now, what we're going to do, in the interest of time, is we're going to take a break so you can download and set up this file. But on Canvas, I put into the files folder a folder called Costco. And I put in a file called Valuation Model Costco Start. Right? And when we get back from the break, we're going to individually build a valuation model in class, DCF, a reusable model that you will later this semester use for your group projects, but that you will have to individually build. And this is going to be your next homework assignment. So your next homework assignment is, if you're able to follow along and recreate the valuation model for Costco in class tonight, and submit it next week, then you've completed your next week's homework assignment in class tonight. If you can't, then you have to watch the video and get to the point of completing the valuation model by the end of tonight or by the end of next week, right? So that's what we're going to do when we get back from the break.